There you go. You're all alive now. So let's talk about that first question about the what if I only have a mortgage? If that's the only debt that I have? Well, the reality is almost nobody only has a mortgage as a debt. There's always something that you can point to. And it may not be a debt they have currently right now. It could be I'm getting ready to put a new set of tires on my car. It could be I've got Christmas coming up and I know I'm going to spend $1,000 on gifts for Christmas. So if you think through this and you think about these upcoming expenses that you're going to have every year or every other year, then you can incorporate these into a debt elimination strategy. So just like when you're looking, this is a cyclical, a linear event, the debt. You may not incur the debt until 4 or 5 months from now, but that doesn't mean you can't start paying it off before you get there. Okay, so this is a concept that some people, it's difficult to get your head wrapped around it, but I want to show you. So in the example I've got with you that I'm going to show you in just a second, this is someone who only has a mortgage and they just got a mortgage and they're young, 35 years old, but their mortgage is going to be something that they're going to have for 30 years. But using a simple DFL strategy and taking into consideration the fact that they're probably going to buy a car at some point, and they're probably going to own a car, and they're probably going to have car payments, or they're probably going to maybe get that new set of tires, maybe sock some money away for Christmas, whatever, that these are going to be two debts that we can put on the schedule so that when the time comes, there's enough money in there to take out and pay those debts off immediately. But by doing this in advance, being proactive, hyper funding our DFL program in the beginning, we're going to create massive amounts of wealth in the end. And that's what this is all about. This is about capturing money, using money over and over and over again, being able to do dollar cycling, which is using money over and over again, and then putting yourself in a position where eventually you don't have to ask the bank for money. You are the bank. And then you are, and that comes with a whole nother set of problems. You being the banker making the decision, does the debt that you want to borrow money from yourself, does that debt make sense? Is it appropriate? And this is where we talked, and lots of the other times we've done these presentations, we've talked about, do you really need that emergency jet ski? Is it really necessary? And of course, the answer is no. So the idea here is that we want to put ourselves in a position where we can capture that money, have it available for us forever, use it when we need, and really leverage it so that 30-year mortgage that I just took out, I'm going to knock it out in 15 years. Remember, there's something a lot of people have thought out there that you have to have a debt, or you have to have, I think Betsy and I were talking, you have to have 7 debts. Well, that's the sweet spot. Not everybody falls in that category though. You can do this with 1 debt, or even better yet, do it with 0 debt. So let's go ahead and start that scenario. Hold on one second. So what I'm doing right now is I'm going to show you the actual illustration from the carrier that I like to use for these programs. And there's different carriers that we have, and you're going to use them, different carriers for different reasons. But this carrier that I use, there's a number of reasons why, we can have a discussion about that later on. But this particular carrier is called Mutual Trust. This is a very, very basic policy. This is a 35-year-old female, non-tobacco. Okay, if she's relatively healthy, this program will work even better because we're going to get a higher table rating, which means we can spend more money towards PUA. If she's relatively unhealthy, it's also going to work better because in that scenario, the PUA they'll get what we call tabled. And if they get tabled to table 2, table 3, or table 4, it actually makes the program more efficient. So both ways are good. get approved for a better rating, you can spend more towards PUA. Get approved at a worse rating, then the PUA becomes more efficient. Either way works better, works good for the client. Okay, so in this scenario, we're using a $200 a month strategy. So when we talk about setting these programs up for folks, we talk about the efficiency of the dollars that we use. Are we doing a 65-35 split where 65% is going to PUA and 35% is going to go to term and whole life component? Are we doing a 70-30? Are we doing a 60-40? Wherever the case may be, it all works as long as you do the math. So in this scenario, we're doing a $200 a month program, which is a 50-50 program. And just because of this is, by the way, the laws just changed for these programs as of January the 1st this year. So what that means is that money that I'm putting into this program and the term life rider that I have, which is $405,000, is actually creating a higher PUA capacity than previously. And that was one of the key things that changed with the law this year in January, is that now you can put more money into your program. And the reason why this happened is because the wealthiest segment of this population that fund our politicians, I guess, road to becoming elected, they decided in that process of funding those politicians bid for and candidacy, that they've decided that they think it would be better if they can put even more money into these programs. So if you have any illusions about who uses these programs, because these have been around for a while, just take a page out of the wealthy population playbook. This is something they wanted these programs to become even more cash efficient. And now some of these carriers we have programs where you can actually do just 2 payments, period, a 2-pay system, and it'll be a 95% efficient program where 95% of the cash you put in there goes to store and grow cash. So in this scenario, we're using just a basic $200 a month program for a 35-year-old female. Because of the way we structured it, we're able to capture an additional $19,000 a year, almost $20,000 a year. That's a lot of money if they want to fund it. And in this particular person's case, they're going to need to, because the fact that they're going to be paying off their mortgage and a couple other pieces. So let me go ahead and get rid of this. And let me show you the next step of this process. So what we did next was we looked at this particular person, created some standard debts to do this analysis with. Excuse me, I'm eating a cough drop because I'm getting over COVID. I'm trying not to cough on you guys and blast your ears. So this is a DMA report from one of the carriers softwares that we use. And in this scenario, remember how I said we're going to make some assumptions, even though this person doesn't really have any debt. I know that they're going to buy a car, and that car, when we get to buy cars again, I was assuming a relatively inexpensive car, $8,000, used car, $350 a month. That's a normal payment. 6% interest rate. That's normal for a car loan for a used car. I also was assuming that at some point that car is going to need some repairs because it's a used car, or that car is going to need a new set of tires, or that car is going to need a new transmission, whatever. So I'm basing all of these numbers off of a car, okay? Adding a future debt of a car. So in this scenario, I'm saying that whatever they have to do to their car is about $1,400, and I'm giving them a really good interest rate on a credit card of 8%. If this person doesn't have any debt, chances are they're able to get that kind of an interest rate on something like a car loan, a car payment, a personal loan, those kinds of things, because they don't have any debt. And they have a single loan for a house they just took out about a year ago, 347 months of payments left, $240,000 currently on the balance, paying $1,100 a month. This is all standard stuff, people. This is normal. Where they are in their true debt, 29 years to get out of debt. They owe $249, but the reality is with interest, they owe $392. So what this very, very basic program did or asserts is that we can get them out of debt from 29 years to 16.9 years. And we're doing that with a $200 a month program Pretty simple, pretty straightforward. So if the person only has one debt, which is a loan for a home, and that's the only thing they have, it's probable and entirely very likely they're going to be able to afford a $200 a month program. They can probably afford a $300 or $400 a month program if you want to make it an efficient program, because you're going to be capturing a lot more cash. So some of the other things we've taught in the past, we started with $142,000 of scheduled interest. We eliminated $30,000 of it, created $318,000 in liquidity, as well as paid off the mortgage and so on, and created a total benefit of $376,000 for their family. This is again off of just a $200 a month program. A couple of things I want you to be aware of, though. In this particular program, we got them retiring at age 60. We are building up a huge cash value quickly. You can see this particular column right here, the savings balance column. What that is showing us in this particular instance is that the program is not large enough to capture all the cash that we have to go into it. Once we've eliminated the new car loan that we pay down pretty quickly in less than a year, and that extra thing, whatever it ends up being that we have to pay off for our car, once we eliminate those two things, then the amount of cash going to this program is going to exceed what we're able to store, even with the new guidelines. So in this particular case, this is illustrating in the savings balance column here, this is illustrating a savings balance. In other words, a balance that exists somewhere other than this primary DFL vehicle. What could that be? It could be a savings account. Bad idea. 0.25% interest. It could be another DFL. Good idea. So you started on your spouse, your 18-year-old or older child, your mother, your father, your brother, your sister, your best friend, doesn't matter. Some way that you have an insurable interest. Or it could be that instead of starting anything, and this is where the magic happens, we start to do what's called mortgage chunking. This is something we've shown in other videos. And all mortgage chunking is taking large sums of cash, throwing at the mortgage, having it applied as pure principal payment, and that destroys an amortization schedule. So if this person were to use a mortgage chunking strategy, then they wouldn't be sitting with $96,000 in their primary in their backup bank in year 16. That actually what would happen is that money would have been paid into their mortgage over time quickly, eliminated an inordinate amount of additional interest that we were not scheduling. And then creating that annual liquidity column, we're going to max that out every year by doing this. And we're going to put ourselves in a position where this program, worst case scenario, if we're doing mortgage chunking, is going to work 16% faster. So instead of getting this person out of debt in 16.9 years, we're going to get this person out of debt in 15 years, which is a 30-year mortgage cut in half. And all we're doing is a $200 a month payment into this program. Not only is the mortgage cut in half by 15 years, but we've also captured a huge sum of money. Our liquidity is up to $126,000 in this case before we pull the trigger and pay that mortgage off. Okay. So to answer the question, can you do this with just a mortgage? Absolutely. Are there additional things that you would add in? Sure. And then that's just a matter of just thinking through life. This stuff comes up. Okay. I know, for example, I have a car that's 3 years old or 4 years old. I know I'm going to have to replace the tires in my car next year. I know my tires are about $400 each. So I've got a $1,200 bill coming next year. So I can put myself in my bank, and instead of waiting to pay the interest, to take the money out and then pay the loan, pay the debt off, I'm actually going to pay that $100 a month in proactively, build it up so I've got $1,200 more in my account. And then when the time comes to pay that bill for the new tires, I just pull out $1,200 and throw it at those tires, and I'm paid. But the cool thing is that I've captured that $1,200 into my account, and I'm earning interest with it. And in the case of this carrier, I'm earning compounded interest monthly with it for the rest of my life. Okay, big deal, right? $1,200. Well, it is a big deal. So I'm going to show you an illustration in just a second. We're going to talk about what happens with a $5,000 shot in the arm into your DFL program. All right. But before I go there, I'm going to stop for a second. I see some eyes and you guys look like you're glazing over. Does anybody have any questions before I move on? Put you on gallery view so I can see you. There you go. Look at that, Betsy Bar, lady in red. There you go. Tommy D, nice to see you, sir.
Hey, buddy, I'm enjoying this. Thank you for sharing your knowledge with us.
Right on, brother. And we've got DJ Debt Free himself, Keith Fonseca. What's up, brother? For what it's worth, Paul, I did text Brandon Nelson the other day, and I told him how to pronounce your last name. Just FYI.
I'm pretty sure we all did.
Yeah, there you go. Hey, Brett. All right. Hey, Brett, where's Courtney?
I saw her on here, Scott.
I thought I did too, but she seems to have disappeared. She's incognito.
Well, hey, I think, you know what's so cool about this, Scott? It's only $200 a month. That's insane.
I know. This isn't yeah, for $200 a month, I'm eliminating 15 years of mortgage payments. Sign me up, right? And not only am I eliminating 15 years of mortgage payments, I'm capturing 60% of the mortgage as cash value into my program. It's insane.
It's
right. All right.
It's
So
beautiful.
let me do this. I don't see some. Let me see the chat real quick. Please forgive me. Okay. All right, everybody, we have to agree that we're going to forgive Keith Fonseca as he finishes his appointment. So I'm okay with that. Everybody else is. All
It's
right.
finished. Thank
All
you
right.
for your forgiveness.
Yes, you got it, brother. All right, so let's do this. I want to go ahead and look at. All right, hold on. I got to get here. What I'm going to do now is I'm going to show you the way the math works of putting money into the program versus just paying the debt first. And it's pretty staggering how quickly the cash builds up. How do I get there? That's how I get there. Okay, so in this scenario, we're using $5,000 as the example. And the reason why I'm using $5,000 here is because I have a client that just came to me. This is a high net worth client, and they have a lot more than $5,000 they want to put in here, but they also want to pay off a debt, which is one of their sports cars. And they were asking me questions because their head's not quite wrapped around, why does it make sense to pay money into the program and then use money from the program to pay off the debt versus just pay off the debt directly? And so this is where this prompted a mathematical gymnastics that I like to do. And this is just to demonstrate. So you can use this. These metrics follow through. This is if you wrote a DFL. This is if it was based on the Horizon Value program from Mutual Trust from 2019, 2020, or 2021. But if it's something that went into force this year, then you're going to have to change that annual gain to 3% because that's the guaranteed interest as of January 2021. So in this scenario, if I take that $5,000 and I just look at the annual gain of $200 a year on year one, which is 4%. Don't forget, these programs in this particular case, this is compounded monthly. I'm only showing an annual compound here. Okay, so monthly compounding is going to come out 0.65% higher. That's just the way the math works. All right, so but I'm not doing that here. I'm just being conservative. We're just looking at a straight 4% per year.
How you doing?
Okay, yourself.
Good,
Hey,
good,
Everton. Nice to talk to you, man. I'm going to go ahead and mute you. There you go. All right, so in this scenario, $5,000 year one with a 4% gain becomes $5,200. My value, my gain in value is $200. And in year two, this is where you can see the effect of the compounded compound. So what you would think would be another $200 gain, it's not. In year two, it's $408. So my total gain by year two is 408. So it's 200 for year one and 208 for year two because of the compounded compound. And then if you go all the way down the line, at the end, over 20 years, simply by putting my $5,000, which I never lose, into my DFL program, then at the end of that 20 years, I still have that $5,000 plus an additional 5,900. I've got 119% gain, which is good. Don't forget though, these programs are designed to do another thing. They're designed to pay a dividend. I'm not computing a dividend. It's gravy money. And one thing we should know about the dividend has typically there's 16 factors that determine the size of the dividend you're going to receive. One of the factors is how much money you have in there. And another factor is how long has it been in there. So why I can extrapolate what my expected dividend is going to be in a worst case scenario moving forward in time. The truth is I'm wrong. And it's going to be much higher than that, because the longer my money is in there, the greater the dividend is going to be. Okay. And then you have to take into consideration, depending on the carrier, whether there's direct loan recognition or non-direct loan recognition, if they're going to reduce the dividend based on having any part of your PUA bank encumbered, or if they're not. Sometimes some carriers don't care whether you got a loan out or not. They're going to give you your full dividend. And some carriers will not. Some carriers will say, well, look, you got $5,000 in the program, but you've got a loan of $4,000 out. So we're going to give you the full dividend on that $1,000, but we're not going to give you any dividend on the $4,000. And so this is where the math comes into play. You need to do these calculations. Which way is going to be better? Okay. And that's going to show you which direction you should go with whichever carrier you choose. Okay. So that's the lay of the land for this particular examination. A $5,000, do I pay the debt directly off, or do I put the money into my DFL first and then pay the debt off? So this is what happens if you put the money into the DFL first. You end up with a large chunk of change in the end. This is what happens if you try to repay it using the exact program that I just showed you. The May I Make Money program, the $100 more than your target minimum, the $200 a month program. That's this program. So if I take that $5,000 loan and I put it in here, and then I take a loan out, immediately take a loan out, and I'm using my normal process. Remember, when you're using these extra strategies, you have to have a DFL that's funded to begin with. You've got to have something going in here. This holds true if you're doing the mortgage chunking piece, if you're doing the tax capture piece, if you're doing equity capture piece, all those other options that are out there all hold true as long as your primary DFL is still working. Because we're using, in this case, the primary DFL, $200 a month, of which $100 a month is being captured as PUA bank. I'm using it in this scenario to actually pay that debt off, because I want to show you what the difference is. So right now, my $5,000 with my interest, the loan interest that I'm paying, means I'm going to owe $52.38 if I borrow off $5,000. And if I use my $100 a month payoff strategy, where I'm just taking that PUA that I'm putting in from my normal DFL, not making any extra payments, then at the end of the year, I'm going to be down to $4,038. And the beginning of the next year, I've got another charge of the loan based on $4,038 being loaned out. That puts my balance up to $42.30. And then I'm paying off another $1,200 over time. And now I'm down to $30.30 at the end of year 2. End of year 3, down to $19.74. End of year 4, down to $8.68. And by the end of year 5, somewhere through about 3/4 of the way through the year, I've actually paid the loan off completely. And that extra $290 is actually going directly into my PUA bank as additional PUA bank purchase. So in this scenario, I didn't do anything. I put the $5,000 in rather than paying off the debt, because I had the money sitting in my savings account. Put the $5 into my PUA bank, pulled it out immediately and paid off that debt. Notice I did not use any kind of repayment strategy here other than my core DFL. So if I paid that $5,000 off and I'm using the debt snowballing strategy, this program flies. But I'm just giving you, this is a worst case scenario. I'm still only at $200 a month. Worst case scenario. So let's look at some assumptions. So this is a $5,000 credit card that I'm paying off. I'm assuming it's at 7% interest. So this goes back to that in that original illustration we talked about the fact that I'm taking 7% because that's what my credit card's going to be if I've got a good credit rating, if I've got one of those really super low interest credit cards, or if I need to go get that, new water softening system that I'm going to buy that's going to have a straight interest rate of 7% or 6% or something along those lines. And these loans for stuff like that, these larger ticket household items, you're looking at a 5-year standard amortization. And that's what I did. So if I look at this $5,000 over 5 years, my cost, if I take 5 years to pay it off, is going to be $940 in interest. Okay. That's at that 7% rate. So over 5 years, if I do it this way, where I take the 5,000, put it into the PUA bank, pull it out and pay off the loan. If I hadn't done it that way, then that $5,000, the loan interest that I got from an outside source, that $5,000 of interest on that to pay it off would have cost me $940. So we have to, when we're doing true comparisons and we want to do net comparisons, and we have to take an accounting of, well, what happens if I don't do it this way? So if I don't do it this way and I pay the debt off immediately, then I'm not incurring that $940 of interest. But if I do it the way I'm describing, by put the money into the DFL program and then pay it off, then over time, then I would have incurred $940. So let's move on. Boom. So when you add these two pieces together and I look at what's my growth from the DFL versus my cost from having that $5,000 credit card over time. Sorry, that's a little small. Yeah, I can't increase the size. Sorry, guys. Then, basically $940 is $188 a month coming in from my credit card interest that I'm not paying that credit card off with that $5,000 single payment. So in this case, I'm putting the $5,000 in, I'm paying it off over time with $100 per month from my primary DFL business, my $200 a month DFL. And there's the real numbers. In the end of 20 years, okay, we're going to have this DFL for 20 years, especially for 35 years old. At the end of 20 years, I'm $10,000 to the good. If I'd simply taken that money and paid off that $5,000 debt in one shot, I would not be $10,000 to the good. The only thing I would have is $5,000 less debt. So in this case, if you consider not only the increase in cash value, but the fact that the debt is gone, over 20 years, I've increased my money threefold. I've gone from $5,000, trading it for $5,000 of reduced debt, which is a net zero gain, to the point where I've got $5,000 of reduced debt and $10,000 in cash. That's a $15,000 swing in the grand scheme of things. So that standard problem that a lot of new agents run into, and a lot of new folks that have a DFL program in place, and they haven't quite wrapped their head around, why does it make sense to put my money into a program first and then pull it out and use it to pay off a debt? This is why. Because I'm trading 0 for 0 in the old way, or I'm trading X for 3X this way. Okay. So I'm going to shut up for a minute and let you guys ask me any questions. Come on, DJ Keith. You usually have good questions.
So in effect, you have the paid asset, whatever that is, whether it's a credit card or a house or a car or whatever it is, you have the paid asset, but you also have the money.
Yes. You have your money and you get to keep it too. You have your cake and you're eating it too. Actually, you have your cake.
Like free gambling.
Yeah. And really the truth is, at a certain point in the future, at some point, you're actually playing. We heard this on one of our calls earlier today. You're playing with house money, which is great. I'm using your Mr. Carrier, I'm using your money to pay off my debts. Thank you very much. I'm moving on. or Mr. Carey, I'm using your money to grow my retirement. Thank you very much. And then, just to take this a step further, when we talk about the advanced strategies, remember these DFL programs work in 3 phases: maximization, accumulation, distribution. And with each one of these phases, there's additional things that you can do to really leverage how these programs work. And one of those things is, especially in the distribution phase, back when you're in the maximization phase, you can delay the time it takes you to get out of the maximization and into the accumulation phase simply by taking $10,000 tranches, which if you're doing the mortgage chunking routine, then you're used to doing that. You're accustomed to pulling out $10,000 every quarter and throw it at your mortgage. Well, let's do the same thing, but let's throw it at your retirement, and let's buy a $10,000 annuity every quarter and buy 4 $10,000 annuities a year over 3 years. And now you got 12 annuities that are coming to fruition month after month after month. You just created yourself a monthly income when those annuities come to fruition or come to maturity. Yep.
So if I'm speaking in idiot speak, because that's the language I talk.
Thank you, T. I'm glad you're here, Keith, because you can help me explain some of this stuff.
No.
Just do the fisting, brother.
I have a real question. So I owed $5,000 and had $5,000 to pay it off. And you're saying instead of sending the $5,000 to pay it off, if I recycled it, I triple my money.
Yep.
Got it. That's what I took away. Okay.
That's it. So actually, it depends on the length of time, because as we're going the compound to the compound, like if you have a really young person, somebody who's 20, 25, the longer time you have, I mean, you guys know this, the maximum compounding you're getting is happening in the last 2 years of a program. So the further off you can put that last 2 years, the better off it's going to be. So what we just showed you was a 20-year compound, and that was a 20-year annual compound, not monthly, and not taking into considering or considering any kind of dividend or any of that stuff.
So
I'm 30 years, it's not going to be a 3-to-1 return. It's going to be like a 5-to-1 return.
I'm assuming the purpose of the illustration, because most of the people I run into when I talk about 20 or 30 years, they'll say snide things like, I don't know where I'm going to be in 30 years. I'm like, me either, right? But the purpose isn't the fact that it's $5,000, right? It's that most people have like 30 grand or 40 grand, and that you're just illustrating like it can work to that effect or have that kind of impact. Relatively speaking, the bigger the amount, the larger the impact.
Sure. So the purpose of this is twofold, really. Number one is to demonstrate that you don't need a lot of money to do these programs. All this stems from a $200 a month program, which is nothing, right? How many of us, that's what, 5 trips to Starbucks if you're buying for you and a spouse, right? Okay. So this is not a lot of money. Not really, not in the grand scheme of things. That's the first thing I wanted to demonstrate. And the second thing is something you just said, which I wholeheartedly agree. If you actually disagree, if you don't have a plan, you don't know where you're going to be. Okay. If you're banking on the stock market to provide your retirement, you don't know where you're going to be. If you're there's another strategy that uses IULs for these programs. If you're using an IUL, you don't know where you're going to be because you have no control over that index. All you know is that the index might go up and it might go down. You might have a 0 return. Using this program with the par whole life with the guaranteed interest rate, you do know where you're going to be. And this is where you can make solid financial plans because you can control it. And that's a critical thing here.
Yeah, I love that. When I've come up against folks that say, well, the 30-year return, traditional return on this is this and that and the other thing, I'm like, cool. So show me where you'll be in 30 years. And you can't guarantee it, and I can.
Yeah. Yeah. And that's another thing, not that I love financial advisors. They're intelligent people. They certainly have their place in this business and in this industry, and they really offer a lot of positive stuff. The one issue I have with most financial advisors, though, is that they don't pay these programs too much attention, and they're not incorporating these programs into their clients' financial programs. They're basing only on the market and market returns and indexes and those kinds of things. And that's practicing what they preach against, which is don't put all your eggs in one basket. So for me, this is a program where you have, all those other things we talk about DFLs. It's tax exempt. You've got 7702A protections. If you do this as a business solution, you've got 162 tax exemption on top of that. And there's other ways where you can, if you structure these right, in theory, you could have a triple tax deduction. Put the money in here, take the money out, put it back into your checking account, look at where you are tax-wise for the year, make a contribution with that money that you pulled out of your DFL that is non-qualified money, but put it into an IRA as a qualified money. What did you just do? Because you're doing a 401k contribution in your current calendar year, you just increased your tax deductions. And if you play it right, you decreased your tax bracket. So yes, you're building up tax. You've already used something you've already paid tax on. I get it. I understand. But there may come a time where I need $12,000 less income this year so I can get to the next lower tax bracket. This is a great way to do it. It's a great place to store cash to do that kind of stuff with. All right, we're running fast. Great. All right, Betsy, I see you shaking your head. Let's hear something.
Oh, no. Well, hey, I was just looking at some of the comments in the chat. I think people are asking some great questions.
Oh,
And these are, the ways that you can do this. I was actually thinking about a nonprofit case that I'm working on too. And then that's phenomenal because you don't have to worry about like MEC status and stuff. But Trish had asked about when would you actually pay off the credit card debt, and do you have to contribute money each month? And Trish, it's completely like personalized for each client. Like Scott was saying, some carriers you can just put in like premiums 2 times in a big lump sum, and then the policy's funded. Or you could do it, $200 a month, $500 a month, whatever the premium is. So it's just totally personalized based on whatever the client is, what their situation is and what's going to work for them.
right. Okay. I just saw Priscilla Simpson's question. So these programs, once the program is funded, when you make your first premium payment, if there's a scheduled PUA payment as a component of that premium payment, as soon as the money is received by the carrier, your program is cash in it, and you can start accessing it immediately. So there's a strategy where we have people that have, and I've got a couple of people that are doing right this minute, where they've got $15,000. Actually, here's one. I've got a gentleman who has a home equity line of credit that his interest rate is 2.2%. So he just put $20,000 out of his home equity line of credit at 2.2% interest, put it into his DFL, earning 4% interest, and he's immediately getting positive arbitrage of 1.8%. And then next year, he's going to pull it out and pay the other program off. No brainer, because that money's in there forever.
That's
phenomenal. This is stuff, especially with the cost of money these days, when you're looking at the attractiveness of this program with a guaranteed, in this case, 3% plus a dividend. When you're looking at that versus what you're going to get from a bank, 0.25% if you're depositing at least $10,000, 0.0125% if you're Bank of America and you're putting in less than $10,000. Why? Okay. So and once you put the money in here, the whole idea with these things, which is really cool, when you start taking the money out, they don't let you touch all the money, because you're getting paid a guaranteed interest rate on the full value of your paid up edition bank. And you're getting paid, depending on the carrier that I use, if you're using this one carrier, then you're also getting paid a dividend on the money you don't have encumbered. So if I've got $10,000 in there, but I've taken a $9,000 loan, in theory, the guaranteed interest rate on 10,000 plus the dividend on the 1,000 that's not encumbered should be enough to pay my interest. And therefore, the question comes up all the time: do I have to pay my loan back? No. These are structured so that you really don't have to. You should. There's a logical reason why over time at certain points you're going to. But sometimes it's a judgment call. Sometimes it's, okay, I've got $9,000 in loans out against my $10,000, but I'm in the first year of my program. So because my money hasn't been in this for a long time, the dividend I'm going to get is tiny. Does it make any sense for me to stop buying PUA and increasing my bank capacity? Or does it make more sense to go and pay off that so I can go get that $50 or $60 of dividend? And I'm going to tell you, in the first, second, or third year, it's probably better off just to continue buying paid up additions every year to the maximum rate. And then once you get to that third year where the dividend starts to become sizable, that's when you start thinking about switching over and telling your carrier, yep, those payments I'm making to you, I don't want them to pay off my PUA. I don't want them to buy more PUA. I now want them to pay off my PUA loan. All right. Kim Horn, when we have someone who has a DFL as a potential client, maybe we have, yeah, of course. Yeah, that's, and you've got a couple of, there's heavy hitters here that understand what's going on. You've got certainly Betsy, she's brilliant. Keith Fonseca is fantastic. Tom Deutsch is wonderful. I know a thing or two. Misty Hutton's fantastic. So yeah, you've got a lot of people here that have some experience with this stuff, and you should certainly reach out to them. I would recommend you talk to your upline first, because you never know, your upline might have knowledge about this and might be able to send you to someone that maybe is the designated person for your team. I don't know. It's case by case. But good question, Kim. All right, Betsy, am I missing any other questions?
Let me check in here, but I will just say too, Keith, I'm so sorry. I've been talking to too many people
He
today.
would be so lucky.
Scott's like, we are no longer friends. No, I'm joking. Actually, I've done a lot of cases.
More here than I do.
Right. I've done a lot of cases this week where it was referred to me from an agent that wanted to do DFL. And so we just run them together. And so
Sure.
I love doing that because that adds value to you as the agent. It adds value to your client. And then we get to do more DFL, and I'm obsessed with it. So that's pretty cool too.
Scott, what's the current certification to do a debt-free life policy?
If you're doing it by yourself, on yourself, there's no certification requirement. If you're doing it through Symmetry, and you haven't done them before, you're going to have to go through training. You have to go through a course, get certified. You have to do a presentation to Jeff Sigworth or Mike Resma. And there's some discussion that we've been talking about some additional certifications coming. It's not set yet, but it's on the way. Ashley asked a question.
Oh, sorry. I was going to say Anthony had one too.
Okay, go ahead. Go with Anthony.
Yeah, Anthony asked if someone cashed out a 401k with 45,000 and then does a DFL, what would that return be in 20, 10, 20, 30 years?
Have to do the math.
Yeah.
So this is something, so it depends on what you're doing, because for me, I would be duplicating that. I would put that 45,000 into a DFL as all PUA. And if I needed to do it to have a smaller premium, I would do it over backdate it 6 months, and then do a first payment, half of which in 6 months ago, and then the next half payment in 6 months. That way I'm getting all 45,000 into the program in the first what is that, 180 days.
Yeah.
And then I'm going to pull the money out and I'm going to start daisy chaining it. Maybe I'm going to do an annuity. Maybe I'm going to put it back into an IRA. Who knows? But once the money's yours, it's yours. If the whole key is to get the money into the program and sequestered and get it working for you forever. And in answer to Priscilla's question, yes, the guaranteed interest is now only 3%, but the interest rate they're charging also dropped 1%. So it's still an efficient program. And when you look at coupling that with a dividend and being strategic about how you put the money in and how you take the loan, being strategic with some of the carriers makes a huge difference. So for example, if I put $10,000 in and I want to take a $10,000 loan and I'm paying $1,000 a month, that means I'm going to pay that $10,000 loan off in 10 months. And if I have the carrier that's going to agree that they didn't earn the last 2 months of interest that they took up front, they're going to credit me back 2 months of interest that they took in the beginning. In that scenario, my cost is zero. I paid it up front, 12 out of 12 months. I returned 2 out of 12 months, and that 5 out of 6 months, or that 10 out of 12 months of interest that they took, is about what I'm earning on it. So it's a wash. But there's a more elegant way to do it, it's a little bit more legwork. But for example, if I take that same $10,000 loan, but instead of taking it as one $10,000 loan, I take it as 10 $1,000 loans. Then that means on the first $5,000, I'm earning half my interest. I'm getting paid at least half my interest back. And on the next 5 $1,000 loans, I'm getting back to closer to that zero cost. But I've got half where I still earned half my interest. So in that scenario, in both cases, I've got my $10,000. In both cases, my $10,000 debt or my $10,000 chaining is still taken care of. But in case number 2, I've also earned 1.5% interest on my money. I got my money and I'm using it too. I'm still earning interest with it across the board. My average interest is 1.5%. So the question is, do you take $10,000 just because it's easy and take it in one shot? Or do you take 10 $1,000 loans and earn 1.5% interest average on that $10,000 still, right? So it's a no-brainer as long as you're willing to do the work. All right.
Hey, Scott, sorry, I'm here with Priscilla. Just to follow up on that,
Hello,
is
man.
that like, hey, how's it going, Scott?
Go on, man.
Is that interest rate fixed?
Yes.
So once you get into DFL, it's fixed at the interest at
Yeah,
what you get
the
in?
guaranteed interest rate is a floor. It's fixed. Okay,
Okay.
it will never go down. Once you take into consideration dollar cycling, which is what I just described, where you're using the same dollars and earning interest back and paying interest, but earning some of it back, then your average interest rate can increase, but not beyond 3%. And then once you look at another thing, a key component is some of the carriers say, if you've got a loan out, you can't have the dividend. And some of the carriers say, we don't care if you have a loan out, you can have the dividend. So in the case of the ones that say you can't have a dividend if you have a loan, then it becomes even more of a strategic thought process to how you take the loans and how quickly you're going to pay it back. Because getting paid a dividend on 50% of your money is a hell of a lot better than getting paid a dividend on 10% of your money. Okay. And so that's where, when we look at these things and try to project future outcomes, we can never and never should look at a dividend as a guarantee, because it's not. But I can tell you that 2 of the 3 carriers we use have always paid a dividend every year they've ever been in business. And the one of them is actually the original company that did this program first, starting in 1904. And they were the ones who did the original programs for the Rockefellers and the Rothschilds and Ray Kroc and Doris Christopher and Warren Buffett and the Kennedys and all those people. They're the original. And they are really, really set up to do those little tweaks that I'm talking about how you take the loans, how you manipulate the loan strategy, how you repay it to capture or recapture some of the interest they took, how you recapture some of that dividend, all those kinds of things. And there's a great thing here with that one carrier, which is awesome. If I take a loan and I have that loan out for 359 days, and I pay it back with 1 day left, they give me the full dividend. It's not prorated. That's pretty cool. All right. Let's see.
Someone was asking if the $200 example would work with foresters as well.
Great question. And it depends on the age of the client. I love foresters. They're a great company. I know some of us here like foresters more than the others, and that's fine. One of the key problems that I see with foresters, and I'm sure we've all talked with Kelly Steinmetz in our liaison contact over there. The main problem with foresters program is that there's a $50,000 minimum death benefit for the whole life, which, so if the person's 55 or 60 years old, it's not going to happen for $200 a month, because that whole life piece is going to be more than that. And then taking that into consideration, because they have such a large requirement for the whole life core policy, the problem gets exacerbated if they have poor health. Because where normally we don't care about poor health, because all it's going to do is make the cost of insurance go up, which is going to make the size of the PUA bank go up, make your dollars more efficient. The problem with that is you're going to price yourself right out. So I was just working with somebody yesterday or 2 days ago. They had $842 a month that they wanted to put into one of these programs. And the person was 72 years old. The PUA portion was only going to be like $90 a month because the term was so costly. And then to get there to be room for a PUA, the term rider was also costly for someone that age. And the problem is you only have one choice at that point, which is Foresters. You can't use anybody else because nobody else will insure somebody with that program after age 70. So there's a place. Does it work? Yeah. Will it be efficient? No. And at that point, the reality of what that person should be doing is they should be looking at an alternative insurer. So, who else in that person's family, brother, sister, daughter, son, even younger wife, younger husband, who else in that family is more insurable so that either you can go to another carrier that doesn't have a $50,000 minimum or stay with that carrier, but have the cost be more efficient and being able to capture more PUA. At the end of the day, if you're doing this for life insurance, death benefit, game's over. You do whatever you want to do. If you're doing this for cash value, efficiency is king. And the size of the death benefit is irrelevant. But the cost of these programs, because of the whole life component, is certainly determined by health of the client, age of the client. Okay. Big
Scott.
to take into consideration. Yeah, go ahead.
I'm sorry, that was actually my question. I appreciate you
Okay.
answering that, and I appreciate you doing that. I just kind of have a follow-up to what
Sure.
you said.
Go ahead.
So in the scenario, and I get that part of Foresters, the 50,000 minimum, and when they're older and they have health issues, that can run into a problem. I'm also a newer agent, so I've kind of gone under the theory of, master one first, and that's what I'm doing. So I've only used Foresters, but I'm
Sure.
contracted with the other two, and I intend to also at some point use them as well. But my follow-up question would be, in that scenario where you have someone that maybe has a health issue or they're older and you have to meet that $50,000 death benefit requirement, what is the threshold where you would take 65-35 in order to make it work?
You don't have a choice.
Yeah, right, exactly. So some of these I've done these illustrations where I know in Foresters I can do them on my own where it's 50-50, but is that the right thing? If it's for the purpose of DFL in wealth building, is a 50-50 split the right thing to do by that client?
Right. And I can't answer your question. It's subjective. So what I can tell you is that if you're doing this for PUA, then the answer is make it as efficient as you can. I've done programs that are 95.5 efficient, where 95% of the money is going into PUA. Haven't done one of those in Foresters because you can't. But this is something where the 50-50 target split, or the 65-35 ideal, or the 68-32, all those are subjective. And when you really get into the minutia of planning these programs, there's a lot, you have to go deeper. And the deeper is, okay, well, look, what is your goal? I want to spend $1,300 a month. Does that mean that you schedule all $1,300 a month? And depending on the agency you're with, some are going to say, yeah, you spend all $1,300. Me, no. Okay, so of that $1,300, what was going to be the PUA? The PUA was going to be X. And let's say that X comes down to $800 a month. That's $9,600 a year that you were going to put in there. Okay, so now let's back that out of the equation. Let's go rerun an illustration where I need to have at least $9,600 of PUA on top of whatever it comes to. And then maybe I'm doing a 50-50 or a 60-40 split. And in the end, when I do that and I go back in and redo the math, I've just made a 70-30 or maybe a 75-25 efficient program for my client. I'm the hero. I shot myself in the foot as far as commissions are concerned, but I'm the hero. And if you're doing this for commissions, that's not what this is about. You need to be doing the right thing for your client. We do the right thing every time, all the time, even when nobody's looking, right?
Right.
That's how we do these things. So there's this ebb and flow, this give and take when I'm doing these programs and pricing them out, just like I'm sure Betsy's the same way and Keith is the same way. We're not necessarily looking at how much money do you want to spend per month. Where we're looking at is, okay, well, what do you got? What's your overflow? 2,300. Okay, well, we're going to capture 2,000 a month. Okay, and then move on with the understanding that once you present it to your client, this is cool. Once you present it to your client and they get it and they see it, okay, now they're not putting $2,000 in. Now they're putting every last dime they can find to put in this program because they see it. And when that happens, hold your socks on, because now all the PUA residuals, the PUA is going up and up and up every year, right? All those residuals are kicking in, and now it really is worth your time. Does that help you?
Can I jump in for a second?
Please do,
here?
Keith. Go ahead, brother.
Yeah, I have some feedback here on Howard's question. So first off, thank you for the invitation. You guys don't know how lucky you are to have Scott Forehand doing this every couple of weeks. I'm sure he may or may not like me saying this, but when I started out, I remember Scott Forehand teaching this. I learned it. I remember him saying, and when you hit that point, sit back from the table, stand up and take a bow. Do you remember that? Like, I'll never forget you saying that in a thing where I listened and learned. So continue to come back to this. Okay. So 2 things on your question there, Howard. Number 1, right? Don't overlook the consideration of each client is different. I'm bringing this up because we have this Facebook agents group page. We have these great conversations, and people put up questions of like, should I do this? Or what would you do in this? And it leaves out so much of like the initial interview that any expert would do with a specific client. So I can prove it to you, right, Howard? Just imagine a salesperson walks into your house and sits with your mom and says to your mom, how much can you afford? Doesn't ask how many kids you have, what are you going to do with the money, what's going on in your life, how much can you afford? Oh, I don't know, $1,000. Great. Give me 1,000. Let's write up a ticket and I'll see you later. You would probably find that agent somewhere and, perhaps have some choice words with that person, right? Because there's no real care there. So to your question of like, should I do foresters, whatever, and the PUA stuff, it depends on the person. I have very practically written these cases on high age 60-year-old people where their PUA is very inefficient, but they came to me for mortgage protection and their number 1 goal was protecting their family with insurance. And when they looked at, wait a minute, over 20 years, the net cost of $1 million of insurance for me starting in my mid 60s is nothing. Yeah, give me that one, right? But their PUA is like terrible. But I was able to show them the net cost of the insurance over that time. The PUA helped catch it up. And so this is like an amazing magic potion insurance plan where if they went and bought a term policy, it would be sky high. Or if they went and bought a traditional whole life, it would be sky high and they didn't know this existed, right? Now, why am I saying this specifically to you, Howard Bluetrich? Because I have seen your name on the leaderboard, right? Which means you can sell this. So here's the trap. When you're a new agent doing mortgage protection final expense, master 1, period. Because they're all about the same, right? Foresters, Mutual of Omaha, American Amicable. You heard Brandon yesterday on the national call say, look, let me teach you how to sell term. And he did it in like 45 seconds. Term's term, it's term. They're all about the same. This one's $20 more. This one's $30 more. Like, use the value. God bless you. I tell my agent, park yourself at this carrier, learn that one 6 months to a year, and then we'll talk about everybody else. Fine. Okay. When you're doing something as complicated as this in the background, do not master 1. Master the art of asking for help. 100%. Right? Because if you miswrite a policy for someone, right? And I shared this in our little elite group. I had an agent come to me. She sold a policy. It was $3,000 a month. And the PUA was like non-existent. It was all jacked up, a mess. And I just sat back in my chair and I was like, God bless the lawyer who's going to handle this case 3 years from now for you. Right? I was concerned for her. So my point is, what's that?
Make sure you got E&O.
Yeah. So my point is, don't master the one. Do not. You have 3 carriers. You have, I mean, look, I'll just speak unabashedly. I put 6 SMEs on the screen a couple of days ago. There's a bunch more. Some are in this room. You got unabridged access to Mike Resma and Jeff Sigworth, right? Don't sell it. Don't write it. Don't master it. That's all you go. Call an expert, run through it. Like say, hey, this is what I got. This is what I'm looking at, right? Some of us have more time, less time than the others, but that way you're doing right by the client and learning all 3 at the same time and understanding the subtle differences so that you know which client, which carrier to steer towards for each specific client. Does that make sense? I hope I'm sorry, I didn't take up too much time, Scott. It's just, I felt like it had to be said because that's like the right thing to do.
You
when
know,
no one's
Keith,
looking.
I've got control to mute you at any time, so I can do that.
Okay, perfect.
All right. So Betsy, did we answer all the questions?
Sorry, I was on mute.
Newbie.
Yeah. You think I would know how to do this by now, right? Yeah, just talking about, what are the different, commissions on these, and commissions for DFL get super complicated depending on which carrier you're with. And there's the 3 parts to it, so you want to look carefully. And since their whole life, they're lower than, if you're at 70% or 80%, it's not going to be at that rate. So one time when I split it with an agent, she was like, wait, I thought I would get more. And like, no, remember, we looked it over. So it's not something to where, you're going to get like your 90% commission on it. So you just want to be aware of that. But the great thing about it, and this is, Scott can share about this all day long too. They have great residuals, just in the, not just up front, but we're looking at, long-term for these policies. So
Yeah.
DFL, even when you're talking to your clients, it's not the short game, right? This is not, hey, next week you're going to pay off all your debt. Maybe if they have a chunk of,
Yeah,
I guess it's possible, right?
Yeah.
But most people are not doing that. We're looking at,
Right.
Years down the line. And so same thing with us, like debt-free life. It's not necessarily, it's great. I love writing debt-free life policies, and the commissions can be great on them, but it's also, I'm looking down the road, hey, this is great for my retirement. So.
All right, so here's some metrics about what Betsy was just describing for those of you that are writing DFLs. The residual commission is huge. It dwarfs the initial upfront commission. So there was a question in the chat about, is there a cap? Yep, there is a cap. What is it? Can't tell you. Depends on your commission level, and it depends on which carrier you're talking about. But just because there's a cap, that doesn't mean that you're not going to get paid all you're owed. So there's a cap to the point where the upfront commission can be paid, but beyond that, you're going to get paid as earned. First thing. Second thing, the residual commissions is huge. Because remember, what is this? This is a debt-free life program, which means the client we're talking to has debt. If it happens to be the sweet spot client with 7 debts, okay, that means 2.3 years is the average. It's going to take 2.3 years to where all the primary debts are gone with the exception of the mortgage. So what does that mean for you? That means as those debt snowballs are rolling, and you started off with a $200 a month program where $100 is going to PUA, but you had $19,000 a year as PUA contribution as a max. In your first year, you're not doing $200 a month because you're going to pay off some of your debt early. So in that first year, let's say you pay off a couple of credit cards. Okay, now instead of paying $200 a month, you're paying $400 a month. And then in the second year, you pay off 2 more credit cards and a car. Now you're not paying $400 a month. Now you're paying $1,200 a month. Okay. And then you get to that final, student loan, which are evil, any of those other debts other than the mortgage, to the point where you're throwing in all this money because you're cycling through your dollars. Then at that point, when you look at the residual commissions, because residual commissions are based, depending on the carrier, are based on term and whole life for some carriers and PUA for all carriers. So if I've got a PUA that's jumping from $200 a year in year 1 to $400 a year in year 2 to $1,200 a year in year 3, okay, the residuals that I'm getting in year 3 are 6 times the residuals that I'm getting in year 1.
Mhm.
That's the dirty secret. It's not dirty. This is something when they first presented Debt Free Life in 2018 at our national conference, Brian Popes hit the nail on the head. There are going to be people that are going to be earning $50,000 a year residual commissions starting in year 1. And they're there. Okay.
Is that someone here in this room? Is that what you're saying?
I'm just saying.
Is that happening? Wait.
So I placed 61 policies last year. My expectation, the metric that I use is 48. If I write 48 policies a year, my year 2 residuals should be about $30,000. That should jump up to about $60,000 in year 2. And it should jump up to about $90,000 in year 3. And then, oh yeah, don't forget, we're paying off a mortgage, right? What happens when that mortgage is gone? If your folks are still following the plan and they're still looking at that massive number they're going to have for retirement, then they start making their mortgage payment into their DFL. And that is usually happening somewhere between year 7 and year 9. So in year 7 to year 9, there's going to be one more doubling of the PUA residuals that you're getting. And let's say they pull back and they don't put any more PUA in. They just put the minimum PUA for the year, which is $100. You still get residuals on the term and the whole life, depending on which carrier you're with. So from a residual perspective, this is the ability for you to create a retirement income stream simply by going out and helping people eliminate their debt.
Hey, who's the first person that everybody in here should write a DFL on?
Huh. Yeah. Everyone, if you are a 1099, which I would venture a guess that everybody here is a 1099, why aren't you paying your taxes to yourself and capturing your taxes? There's some video up there that I talk about that. It's silly, people. You're going to pay the taxes. You know you're going to do it. Just pay it as you go into your DFL program and capture it forever. We did a scenario, an analysis of doing the same thing with mortgage chunking, where you're capturing the escrow payments, the home equity, not home equity, the homeowner's insurance and the property taxes that you have to pay every month or pay every year. And most people are paying them to their lender, and their lender's going through and writing those 2 checks a year, right? What's it cost to write 2 checks a year? $6. So to save $6, and so that you don't have to write 4 checks a year, you're going to give your lender the opportunity to earn $290. Okay. Well, what happens if you compound that year over year over year? So I looked at somebody with a $1,700 mortgage, which is an average, small to medium house, right? If that person had done this and done a DFL program and done mortgage chunking with it, and then also captured their home escrows into the thing, they'd have an additional $120,000 at year 15. And they'd be making $5,900 a year at year 15. That's just guaranteed interest rate. That's not the dividend included. And that's almost enough where it pays taxes and insurance. Actually, year 17 is where that usually happens. So how many people are going to own their house for 17 years? Maybe some, if it's the final house, but if they don't own their house for 17 years, are they going to own another house? Yeah. So if they continue to do this in the 17th year of the program, not the 17th year of owning the house, in the 17th year of the program, there's enough money generated just from the guaranteed interest of that program to pay your homeowner's insurance and your taxes. That's when you stand up, you say, hey, I'm Keith Fonseca, and you take a bow.
Did you just say at year 15 they'd have 120 grand?
Yeah.
Sorry.
Yeah, that's one of my favorite illustrations you have, Scott. It's such a simple concept, but makes a huge impact. Just a little change.
For the record, everybody that was here, you just heard my wife call me simple.
It is recorded.
It's for everyone to know. But it's like, Scott, we can really help people that just really don't know. Like, people just
Yeah.
don't know about this. That's the thing. Like, they're just not aware. I mean,
Yeah.
I know I didn't know about all this before I started learning about debt-free life. And, I considered myself fairly, intelligent, but I had no clue about all this.
You're a
And now
smart
it's like,
cookie.
but it's just totally changed the way that our family approaches money. Like, I'm not worried about my boys and whatever choices they make in terms of careers and things like that. I know they're going to be fine. They're going to be able to support their families, their grandkids, like we're going to be fine because we're taking advantage of these types of strategies. So we can really, this is really about making a positive impact on people's lives.
Right.
And, it's, that's why I do it.
Yep.
I love it. You're changing
I-
what people their future
Yep.
looks like.
I like the math. For me, it's like a puzzle, and I love doing puzzles. So this is fun to me.
Yeah.
All right. All right. We got a few more minutes. If anybody else has any questions or comments.
Oh, there was a great question here. Ashley asked, is there a maximum amount of money that you can put in a DFL?
Right.
And it's all subjective.
Yeah. So right now, currently, with mutual trust, you can put in $100,000 a year without getting an exception. With Lafayette, you can put in $200,000 a year without getting an exception. And with Foresters, you can put in $300,000 a year. We have it on authority that there's another carrier coming where you can put in up to $1 million a year.
And we're so excited.
It's going to be awesome. Yep. All right.
Hey, the DFL guy, I got a question for you. So basically, when you go to DFL boot camp and everything, all the illustrations are done in Foresters, right? I'm appointed with Mutual Trust Life, and I've done 2 with them before. About 10 months ago, I've done 10 total. Is there any videos, or can you do an illustration sometime on how to fill the application, how to do the paperwork with Mutual Trust for the people that it will work better for in this scenario?
Yeah, I did a training about 1.5 years ago, and it's up on, I think it's private though, so I can get you the link, but it's how do you do a DFL from beginning to end, and it uses Mutual Trust as the carrier. So you'll see how to do a Mutual Trust application and illustration.
Thanks, that's awesome.
All right. Is New York off limits? Trish Muller, nope. Foresters is in New York. Although New York just changed their laws, and now it's even harder to write a policy in New York. Now they want you basically just to do a basic life insurance. They want you to do a full financial analysis to make sure that the client can afford the life insurance that they said they want. So this is a perfect example of Big Brother making a decision for the client. Where can we access my videos? You can Google me. Kim, yes, I'm licensed all over the country. There's lots of YouTube stuff up there on YouTube. I also have a Vimeo channel, which has some, they're branded, but there's some videos, they're purpose-built videos, and you can check those out. I do have other people that use those videos. They send them to their clients to help them explain DFL to them. You're welcome to do that. If you do, just so they're not calling me, and I'm not trying to steal your client, just say, hey, this is one of my colleagues. This is something he put together. It'll help you understand. Go take a look at it. And I have probably a dozen people within the Kevin Purdy master hierarchy that are doing it that way. And they're using that as a resource tool to get past that first introduction and the first touch. I think that's it. We done? You guys ready for the quiz?
Bring it on. Pop quiz. Let's go.
What does the winner get?
The winner gets 1 hour free training with DJ Keith Fonseca.
There is no such thing.
All right. So really the purpose of today was and I think most of you are agents that are on this call. The purpose of today was really to let you understand, no, it doesn't require more than just a mortgage. Because remember, the DFL programs works in phases. So if you don't even have a mortgage, then you're still, it's not called DFL at that point, it's called an infinite bank. Same thing, same concept, okay? But one other thing I want people to understand, if you're really savvy with these programs and you start to use them and you really get how they work, you're gonna jump back and forth. You're gonna start in the debt elimination, which is the maximization phase. You're gonna get to the point where you're out of debt and you're into the maximum and you're into the accumulation phase. But another debt's going to come up, you know, and then you get to exercise the golden rule. The man with or woman with the gold makes the rules. You walk into that car dealership, you take a $20,000 loan from yourself, walk up to that car dealer and say, yeah, you see that car over there that's been on your lot for 6 months that you've got a price tag of $29,000? I'll give you $20,000 cash. And what's going to happen? They're going to trip over themselves going back to their manager, trying to get the paperwork so that you can come in and collect your $20,000 cash and get that car off their lot. Okay. So this is about putting you in a situation where you are able to use your dollars efficiently and you really have choices. So if you're an agent and you're making money and you're successful here at Symmetry, write your own DFL. Start your tax escrow piece. If you have a mortgage and you have a conventional mortgage, write your own DFL. Stop paying your homeowner's insurance and your property taxes to your lender. Pay them to yourself. You capture the money forever. And then finally, when you're in the process and you've written that DFL and you get to see and understand the mechanics of how it works, teach somebody. Pass it on. This is a great piece that's going to help a lot of people in this country. That's my 2 cents. All right.
And you can't take the escrow out of a VA loan.
Right. No
Or
VA,
FHA.
no VA, and no FHA. 60% of
way-
all loans are conventional, though. By the way.
Scott's 2 cents are now 6.5 cents because it's been sitting in a DFL.
Right on, man. Yeah. Right on.
Boom. That's pretty sweet.
All right, guys and gals, thank you for coming. Hopefully you got something
Thank you,
for this.
Scott.
Thank you so much, Keith and Betsy, for coming and helping out. Appreciate you guys.
Pleasure.
Tomorrow's Friday. I'm going to see you guys again tomorrow.
That's right.
That's right. 11 a.m., right? All right.
Yep.
All right. Everybody have a great night, and we'll see you next time. This will not be posted on YouTube. This will be on Vimeo. All right. All right. Have a good night, guys.
Get to feeling better, Scott.
Thanks.
Thanks.
See you guys.
There she is, Scott.